Okay, good evening, everybody. Just a sound check. If you guys can hear me loud and clear, can you just put in the comment section below? Today or this evening, we have a very special guest, Mr. Kelvin Chow from Lendlease REIT that's listed on the SGX. Kelvin, can you hear me? Yep. Can you hear me? Let me just do a mic check. Can you say something?
Sorry, I can't hear.
Yes, we can hear you. Yep. We can try the volume.
I think I can't hear you guys. Can you hear me?
Yes. Yes, we can hear
I
you.
can't hear you actually.
Oh, you can't hear me?
Not sure why, but I can continue if that's is it okay for you? But I actually can't hear you.
Oh, okay. Let me just check. It's all right. Let me just send you a message.
Yep, I think it's better now. Sorry about that. Yeah,
that's all right. Can you hear me now?
Absolutely good. Yeah.
Okay, fantastic. Okay, welcome. Right. Thank you, everyone. Thank you for all the comments. Welcome. Good evening, everybody. Tonight we have a very special guest, Mr. Kelvin Chow. Mr. Kelvin Chow. He is the CEO of Lendlease REIT, which is listed on the SGX. Thank you for spending time with us here, Kelvin.
No worry. I think thanks for inviting us. I think I'm very excited to share with you and also the audience on Lendlease REIT.
Right. Wow. Yeah. So before we get started, just a very quick disclaimer to everyone here. So this is purely for educational purposes. This is not a buy, sell, hold, or recommendation, right? So what we're gonna do is I'm gonna introduce Mr. Kelvin, and then he's gonna get started on the presentation. Of course, if you guys have at any point any questions, just put it in the comment section below, and then we'll head to the Q&A segment at the end, right? Now, for those of you who may not have heard of Lendlease Group, they're a multinational construction, infrastructure, property company. They are listed on the SGX, headquartered in Sydney, Australia. Their market cap, it's about almost 10 billion Australian dollars, right? So this is Lendlease REIT, which is listed on the SGX, right? So about 3 or 4 weeks ago, we actually did a coverage on REITs. If you guys have missed that episode, you can actually check it out in our archive section and kind of have a read. So we thought it would be great to have a CEO of a REIT from the SGX, right? Because I know interest rates are now very, very low. Everyone is kind of looking for, what kind of yields can I get without taking too much risk, right? And today, we're very proud to have Mr. Kelvin Chow here to present and speak about his company. Again, if you guys have any questions, don't forget, just put in the comment section below. Now, all the slides that Kelvin will be presenting, it's actually available for you. So all you have to do is send us a WhatsApp on 603-8408-2070 to actually click on the Singapore freebies, and you can actually download the slides at the end of this segment. Right now, of course, if you guys are on the SGX and you want more resources, you can always download the SGX mobile app. They also have a Telegram channel where they update you on the latest updates happenings on the SGX market. You may not be able to scan the QR code because if you're watching this on your phone, that might be a bit hard. But you go to sgx.com, you'll be able to get all the links and details and all the helpful resources you can find there. Of course, not to mention, if you guys are looking to trade the SGX, you have online brokers like Poems, which is Philip Securities, or Tiger Brokers. They are pure online brokers. You can go online and set up an account. Of course, not to forget our Malaysian brokers here in Malaysia that also offer Singapore stocks as well. So if you have yet to open an account, you can do it. So now tonight is going to be a little bit special. If you guys tune in and listen in, we actually have a kind of an online lucky draw kind of thing. So you can see at the bottom where we're flagging out a link here. So probably after the presentation, what we're going to do is the first 5 respondents to this quiz, right, is actually going to get 30 ringgit touch and go, okay, just for a little bit of fun, okay. So make sure you guys tune in and listen in carefully, right? So at the end, you guys, the first 5 respondents will answer these questions correctly, and I'll be announcing the winners at the end of the show. All right, so without much ado, Kelvin, I'll bring this on to you. What I'll do is I've got your slides here with me. Let me just kind of pull that out. Okay, right here. Okay, over to you, Kelvin.
All right, thanks, Alvin. I think first of all, good evening to everyone, and thanks for tuning in to this forum to sort of like let me go through with you what is Lendlease Global Commercial REIT about. I think first of all, just like to share with you that the REIT is actually listed on the 2nd of October last year, and I would say that we have it is a very successful listing. Basically, we are 14.5 times oversubscribed, as well supported by a lot of real estate specialists, and also a lot of good funds named like Great Eastern, and also to certain extent, if let's say you know of some Temasek fund, actually we are well supported by also some Temasek fund to sort of like get this listing successfully launched. And technically, we are one of the few REITs that actually has this sort of strong sponsor and strong cornerstone investor, which I think that is something that is remarkable. And I think it shows that, there's a lot of support for our listing, and also a lot of support on our portfolios. I think this is the background of our listing. I will go to the slides. Maybe we move to the next slides. I think
okay, yep.
After this. Yep. Okay, this is the content, but I think we can skip that. I think we go straight to the next slide.
Yeah.
Okay, so basically, so what is Lendlease Global Commercial REIT? Basically, we have 2 assets in the portfolio with excellent operating metrics. I think first asset that we if you know about 313 at Somerset, is basically one of the iconic shopping mall along the Orchard Road shopping belt. I think this is one of the assets that we have. And we have also 3 Grade A freehold offices in Milan. I think these are very new asset. I think in average actually it's less than 10 years. And the occupancy rate is 99% with a long WALE of 9.5 years. Approximately 78% of the lease will expire beyond 2024, which is actually that means your exposure to any listing risk will be very minimum, given that kind of expiry beyond 2024. So basically, we are able to actually provide a very stable cash flow. I think stable cash flow is very important when it comes to distribution, given that we have this asset in Milan, which actually give us a very good, generate very good stable income. I think the other things that we would like to also emphasize is our tax transparency and tax exemptions arrangement. If you look at some of the REITs, be it in Singapore or in overseas, they tend to have to pay some withholding tax and corporate tax, and all sorts of things that actually sort of like reduce your distributable income. I think for our case, I think we structured in a very effective manner, or a very efficient manner, so that wherever income that's generated from our mall, which is the 313 at Somerset, all the income will be straightaway distributed. It can be straightaway distributed to the unit holders. Likewise, for our investment in Milan, what we receive from the tenant, of course, netting off all the expenses that we have, I think it will also be able to fully distribute to the unit holders without even any withholding tax from income overseas back to Singapore for distribution. I think that is a very unique structure. I think even some of the pure play Europe fund might not have this structure. I think that is something that we can sort of like maximize the return and reduce the tax exposure to all our unit holders. So we move to the next slide.
Sure. So Kelvin, just to understand a little bit more, which means that whatever revenue or rental leases that you get, it's fully transferable and there's no withholding tax. Is from Milan. Is that right?
Yeah, absolutely right. Yeah, I think this structure we have been trying to work with the authorities for I think probably close to a year to sort of get it agreed and get it established. So I mean, some of my other friends or peers from other REITs was also quite surprised that we can manage to get this pass through of income without taxing. I think we quite remarkable to that. And the structure is very simple to understand. I think you just need to get through some of the authorities and actually justify yourself in how that is being operated and what is the fund, what is the trust in Singapore means to them. I think that you just need to explain to them. I think and make it clear. I think of course, I think they have to establish some trust. That's why it took us some time to get it through. But I mean, some of the REITs has some Europe asset, but I don't think they got that kind of tax transparency arrangement that we have.
Okay, thanks. Just maybe so for some of our viewers here, would you be able kind of like to put it into very simple terms? What do you mean by long whale, right? To us, whale is that mammal big mammal that lives in the sea, right? Without the H, right? Yeah.
Yeah. Okay. Basically, real is mean with the average lease expiry. So, I mean, if you will take into considerations like what are the leases that you have so far signed with all the tenants, and then with that they do average and see what is the kind of, how long is that kind of tenure in a way. So in that case, I mean, of course, the longer it is, that means the longer cash flow you will be able to generate from your operation. So in that case, of course, I mean, for example, if you look at hotels, there's no, I mean, they hardly probably have any long will because of the, I mean, commitment of the stay. I mean, you just go there for stay a few days, maybe a week, accounting. So your will technically be short. So in that case, your assurance of cash flow or your assurance of distribution will tends to be compromised in such a way. But for us, I mean, given that we are looking at a REIT, which is a stable kind of structure to sort of give a stable kind of distribution to the unit holders, I think will become something that we tends to be one of the parameters that we want to look at in order to assure, first of all, to the unit holders that I mean the distributions are in place and actually are quite secure, given that we have a secure committed lease. And also to the banks, I think they will probably look at it in a way that I mean there are cash flow that's coming in to sort of like for them it's a safe lending because they know that you have cash flow to back up the cost of borrowing and all those things. So in that case, it also works very well. I think if let's say we go on to the raters, I think raters will also like it, given that I mean with that kind of stabilized cash flow, they will be able to sort of like foresee what is the performance of the REIT and all those things. I think these are is a very good indicators for us to sort of use it to monitor the health of the REIT. I think. Yeah.
Okay. Thanks for that. So let me kind of move on to the next slide here. Yes. Okay.
Yeah. I think this slide is basically just a short introduction of the sponsors. As we have clearly stated, I think Lendlease Commercial, not Lendlease Corporate Limited, is basically an international property and infrastructure group with a core expertise in shaping cities and also creating strong and connected communities with operation in Australia, Asia, Europe, and also America. I mean, if you talk about size itself, I think we are probably quite equivalent or even bigger than CapitaLand. I mean, although CapitaLand is really been backed by, technically government in a way to somehow or another, directly or indirectly. But I think for Lendlease is really a private company that actually sort of get it listed, and then we have been operate since 1958. So we are actually having a very healthy growth, and also we go through a lot of different cycle of the economy, and I think we stand strong after every of the different cycles. I think Lendlease is in present with 17 key gateway cities across the world. I mean, we try to be very defined and very specific on where we want to go to. I mean, you can go to anywhere to grow, but I think for us, we do a very thorough study, and we identify these 17 key cities, which is the city that we want to actually further expand our presence and growth in that city. So in that case, it's very dedicated kind of effort to solve, and also dedicated and very focused effort to sort of get ourselves involved in these few cities. I think as at 30th of June 2020, I think Lendlease do have a very good development pipeline of around 113 billion, and also fund under managed of around 36 billion. And also we have construction backlog of around 14 billion. I think one thing is good to share is that Lendlease has been in the private fund domain for a long time. So we have been managing funds for around 150 key capital partners in properties and infrastructure investment. So we are expert in this area, although we don't actually do. Although we are not very visible, compared to other fund manager in the listed domain, but we are very active in the private domain. So with that as an establishment, I think the next step they actually thought of is really to get a listed vehicle. So Lendlease Global Commercial REIT, which listed last year, is one of the strategic moves that I think the corporate is actually thinking about, and this will be the only listed REIT that they have. So what it means that this REIT will effectively be able to tap onto all the commercial asset that is available, either from the development pipelines, or either from the fund under managed, or even to the extent of the construction. It could even be somehow through the connections that we have, be it our partners or our other constructions, associate or whatever, to sort of grow the REIT. So I think that's very different compared to other REITs that has no sponsor, or rather the sponsor has unclear pipeline, or there's nothing in the bags for them to actually grow. I think for us, I think we do have a lot of things in the bag. So we can be very selective, and we could be very selective, and we can be very clear of what we want. Of course, it doesn't mean that of these 17 key gateway cities, we will have to be present in all the cities. I think we can decide on which are the areas or which are the cities that we feel it give us a very good growth strategies and all those things before we actually embark on it, and then grow in size and skills in terms of our operation. So I think it just hopefully that gives you some flavor of our ability to grow. Given that we will be the only REIT that holding commercial asset within the whole group. So in that case, I think that will give us a very good aspect of growing in the near future. Yeah.
Okay. Thanks, Stephen. Actually, Stephen mentioned, Lendlease is also in Malaysia. TRX, right? Tun Razak Exchange. Because I remember when I was a student in Australia, you see Lendlease everywhere. You guys, big company, right? But I guess in Malaysia, less of. But you're right. I think Stephen will come back to that question later, and then we'll let Kelvin continue first. All right.
Yeah.
Okay. So next slide.
Yeah.
Okay. Hang on. Yep. Okay. So this one. Yep.
Okay, I think this is something that we sort of acquired. It is the first acquisition that we did after the listing, which is we did it somewhere on 2nd of October this year, which is exactly a year after our listing. So I think basically, if those that are familiar with GEM, they know that this is also one of the very iconic shopping mall in the west of Singapore, and actually is a very highly there's a high population in that area, which is a very good start urban mall, I would say. So I think there's few reasons why we actually want to acquire this asset. I think this asset basically, I mean, with a 5% interest in a fund that we hold this asset, I think we sort of have a preemptive right to sort of give us an opportunity to grow in future of this holding more stake in this asset. I think the second thing, of course, and also one of the most important thing is that this investment do give us a very good accretive investment also to the distribution. I think that one of the things that we always have in mind as and when we do this asset do actually give us that kind of accretion in distribution.
Kelvin, I see on the picture that there's a big IKEA logo there. Is that the main tenant in this mall?
Yeah, I think it's a good question, and I think that also go into the next point. Basically, what happened is this is not only a mall itself; it's an integrated development. So what happened is that it has an office building. It also have a mall. The office building itself actually is around 35% of the NLA, and the office building is fully let to the Ministry of National Development of Singapore for very long very long lease. I always use will, but it's long lease. It's 20 over years, if I'm wrong. So in the case, that will give, again, a stabilized cash flow to the unit holder. And yeah, come to the mall. Yes, IKEA has sort of like established their first outlet in a mall. I mean, IKEA in Singapore tends to actually take up like a premise, and then they have a full operation in the premises and all those things. They have 2 locations in Singapore now, but this is the 3rd location that they have, and they intend to actually set it in a mall. And they actually look at all the malls around the area around Jam. I mean, we call it Jurong, and they decided to set their first ideal concept of set up in us, and that take up around 12 to 13% of more space. Again, this is a long lease. So in the case with IKEA as a strong name in the mall, I think again you provide a very good stable cash flow. That's the whole idea of the whole REIT operation. I think the REIT operation, of course, you need to actually increase and have the incremental effect of the cash flow itself. I mean, to a certain extent, I think we also have to have some layer of stabilized cash flow, so that in that case, I think the unit holder when invest in us know that, I mean, there is somehow some kind of distribution that they can be able to receive in the mall in our portfolio. At the same time, there are also some factors of kickers that actually improve on the distribution. I think that is what we want to establish in the longer term in the REIT. Yeah. So that's the whole idea. We start to actually have a small stake in it, and this basically this mall is managed by Lendlease in Singapore. And so in that case, I mean, as and when we have a chance, we will improve our stake, and then to sort of like grow our overall holding in this portfolio, in these properties, and hopefully it can actually put in the portfolio, which actually give a very good stabilized income to the unit holder. I think that's the whole idea. Yeah.
Oh, so it's kind of related in a way, right? So Lendlease Asia Retail Investment Fund owns this whole mall, and Lendlease REIT took a 5% stake in this fund. Is that right?
I think you have a 75%, right? Because this Lendlease Asia Retail Investment Fund 3 is basically holds 75% of this mall. That's another fund that actually holds 25%. So both funds is actually managed by Lendlease. Just that I mean, during the structuring and during the early days, when they actually own this asset, I think they actually form 2 interest funds to it. So in that case, it become a bit different, but both fund is managed by us. So we technically we manage the whole mall in a way 100%. It's just that it break into 2 funds, but we start with a 5% interest in it. So in that case, basically our effective interest is only 3.75, given that Lendlease Asia Retail Investment Fund 3 is only 75%.
I see.
Yeah.
Okay. Right. Okay. Thank you.
No worry. Okay, we can move to next if.
Next slide. Okay. All right.
Yeah. Okay, I think this basically just gives you some understanding of our portfolio of the portfolio metrics. It just basically share with you that our portfolio occupancy is around 99%. Again, WIL, as we spoke, I think is around 9.5 years, and I think another interesting metric, of course, is the tenant retention. How well you can retain the tenants. Of course, it's a tricky numbers. Of course, the higher it is, it seems to be. You can actually retain it. The tenant and the tenant is very sticky to the mall. I think this 80% is really a high number, I would say. But of course, to us, it also gives us the option to choose. That means since our tenant is so sticky, then we can actually sort of decide which are the tenants that can continue to sort of provide us or provide our shoppers with the right services and products that actually continue to cut them to or attract them to the mall. I think for those that understand more, they will know that the mall is a very difficult asset to manage compared to a pure office or maybe pure industry. The relationship is only the tenants and the landlord. But for more, I think we also have to make sure that the shoppers are there to sort of support our tenant indirectly, and then the tenant will be happy to stay in the mall, and then with that, then we will also have a happy tenant and landlord relationship. So that is what we're trying to. That is why the asset is very difficult to do, and that's also one of the key metrics why we want to monitor ourselves in terms of the tenant retention. Yeah, I think that's about 80%. In terms of capital management wise, we are on gearing wise, we have 35.6%, which is a pretty low number. So it gives us some headroom to sort of borrow more if let's say we want to grow, and through that borrowing, of course, is one of the cheapest source of funding, which actually is good for expansion and also good for yield projections. I think that is what that's why we want to keep some. Keep the gearing as low as possible to sort of give us the ability to grow in the future. So with the average running cost of debt at 0.86%, this basically means that our cost of funding is only 0.86% of our borrowing. So in the case, it's relatively low. I think of course, it can relate to our borrowing in euro dollars because of our exposure in Milan. And but I think this also means that when it comes to distribution, of course, you will have to net off your cost of borrowing. And given that it's only 0.86%, it also means that the distribution could be, it just tick off a little bit lesser on the distribution compared to the other peers. Yeah, I think that's what I mean. So interest coverage ratio 9.2 times. I think that is something that is in a comfortable range. So in terms of any crisis or what, when your operation income start to shrink, so how long can you sustain to pay off your interest? How good you can sustain to pay off your interest? I think people look at interest coverage ratio. I think for us it's 9.2 times. It's relatively high also. Yeah. So I think that's on this slide. If not, I will move on to next.
Okay. Yeah, in Malaysia, we have a lot of malls. Suddenly everyone wanted to get in malls, and now we have a lot of empty malls, right? So trying to managing malls is you're right. It's not an easy task.
Yeah, I think managing mall is, as you rightly say, it's not easy task, and a lot of time is how well you can understand your shoppers, what is the identity of your malls, and also how you then actually bring out the identities and differentiate yourself. I think that is something that is key. Of course, the locations of the mall is also important. So in that case, that is how we sort of like put all the factors together to decide how do you want to actually put a tenant into the mall. So sometimes you can put a tenant in the mall that actually give you a very good rental rate, but eventually, it doesn't appeal to the shoppers and kind of things. You will at the end of the day, you will lose footfall, and you'll lose probably over or more sales. That's something you might need to consider carefully also. So to us, it's very careful about that. So I think this slide basically just give you some ideas of how our weighted average lease expiry are stacked up. I think basically if you look at FY 2021, I think just probably a little bit understanding of our financial years. Basically, our financial year start from July to June. That's mean July to June. So as at now, you are just probably a few months from the for the financial year of FY 2021. So if you look at it, basically we are seeing that we only have around 3% based on NLA or 12% based on GRI of the leases expiring this year, and it's actually quite well staggered. A stack up along the next few years. So in that case, it also means that the cash flow is quite stable in a way, so that I think that basically the risk of the renewal and all those things are also quite evenly spread, so that at any point of time, I think there's no concentrated risk on lease new renewal that actually will jeopardize the distributions or jeopardize the cash flow in a way. So in that case, that's how we sort of interpret this.
Yeah. Kelvin, I just a question here. Can you kind of help us understand the top part of this graph here, where we talk about WALE of 9.5 years, which I think you explained earlier. What is 4.9 years by GRI? How can you break it down for us?
Sure.
Yeah.
I think GRI, of course, is gross rental income. Basically, there are two ways that the market will measure the WALE. Of course, based on NLA, that's been the size of the tenants actually take in compared to the expiry itself. So in relation to the expiry. So if you base on the NLA net lettable area, so that's mean those that actually take more bigger areas tends to also be more sticky. That's why the expiry tends to be pushing out further than, it's about 78% of the kind of tenants that actually sort of like have that kind of lease expire beyond 2024. Whereas if you look at the revenues wise, of course, I think it's also relative in a way, given that tenants pay take a higher, bigger areas tends to pay a lower rental. And then that in terms of revenue contribution wise, that is not actually proportion or equal, to a certain extent. So in the case, from the revenue perspective, it will become relatively lower compared to the one based on the NLA. But it's all the relationship between either the NLA to the length of their tenure, or based on the GRI to the length of the tenure. So this is the two factors that people tend to look at it in terms of analyzing the WALE.
Okay. So it's 4.9 years by gross rental income. Is that right?
Gross, okay. Yeah, that's right. Gross rental income.
Okay. All right. Okay. So I'll move on to the next slide. You have more next slide?
Yeah, sure. Yeah, I'll go. Right.
Okay. Cool.
Okay. This is just a very static information on 313. I believe a lot of you all that listen to us now are very familiar with 313. I hope so. And basically, it's one of the. We are of the 10 years now. The operations, and it's a relatively new mall along Orchard Road, and basically you have in total 8 retail level. 3 basement and actually 5 floors, 5 above ground floors. I think in terms of occupancy. Sorry, my Siri thought.
All right.
I'm sorry. So basically, on occupancy wise, we are around 95.6%. Just give you some understanding. Our average occupancy is about 90% in the Orchard Road, or also probably in the Singapore Island wide. So in that case, we are surely above the average. I think the WALE by itself is around 1.6 years or 1.7 years based on NLA or GRI. It's very close. This means that the space is and in terms of the rental and the space are quite proportionate. So appraised value 1.008 billion, I think, and with the cap of 4.25 years. NLA 288,000 square feet. And of course, we own the asset 100%. And this is a 99-year lease whole properties. Yeah.
Okay. Yep.
We can move to next.
Yep.
So if you look at this little, there's a picture on the top left-hand corner. You can surely see that. I mean, the slightly pinkish line is the whole Orchard Road. I mean, as you can see, and we are really at the center of the whole Orchard Road. And I think recently, which I think actually not so recent, actually before the COVID, the government actually sort of announced to rejuvenate the whole Orchard Road. I mean, if you know about Orchard Road, it's one of this shopping belt in the world that people are known of and kind of thing. And government will like to be continue to be attractions to the travelers and also to the tourists. So in that case, we intend to do rejuvenize the whole areas. So the whole rejuvenation plan, technically, as what we heard, is actually break into three different precincts. The first areas that is probably from Ion Orchard to somewhere close to Mandarin Orchard will be considered as like a shopping areas when they continue to actually emphasize on more shoppings and kind of things. Whereas the area that 313 has is actually become a very youth-centric areas when they want to attract the youngsters and the young professionals to sort of like gather around, have exciting events, activities around the areas. Of course, it doesn't mean that the mall is not relevant. The mall is still relevant, but it provides the kind of offering and services, activities to sort of get this crowd around the area. And that's where it is. And I think the last, of course, I think somewhere after Orchard Central and beyond, where the Istana is, I mean, which Singapore house our prime presidents, I mean, the Istana area is basically will become a garden-like kind of areas, which I think they will make more greenery kind of things. I think it's a extension of how the Istana is being also panned out to be. Is also very garden-like. So in that case, that would be that kind of area. So I think that the whole rejuvenation plan is very much blend into our whole mall strategy and also how we want to differentiate ourselves. Because for us, our focus is really the youth and young professionals that actually sort of like to actually come together and have some fun and also at the same time meet up for some activities and events or maybe have a meal and kind of things. And also all the relevant offerings that we have is also very suitable for them. And I think that's what we want to want to continue to differentiate ourselves and transform ourselves. And very coincidentally, I think it's also what the government think of that areas to be. I think hopefully it's our influence to the decision, or maybe the government influence us. We don't know. But so far it's been much aligned with what we are thinking of in the whole mall. So I think it's good. I mean, that's a good ideas that we.
Is there like a timeline to this rejuvenation plan? Like, has the government set any timeline on this?
I think they did, but of course, given the COVID situation, probably it will be pushed back a bit. But if not wrong, it's actually sort of like five years, or I mean, here and there kind of plan that actually did want to change it. Yeah.
Okay.
Yeah.
Okay.
Right.
Thanks. All right. So let me move on. Yeah. So this.
Yeah. I think further to what we have thought about the rejuvenation plan, I think this is also a pristine, or rather a small little car park areas that actually very near to our mall, which actually probably I would say even 1 minute or probably less than 1 minute kind of walking distance to a mall. So again, given that I think government quite happy with the way that actually sort of we want to actually transform the areas. So we are fortunate that we are being awarded this area to be redeveloped to very eventful kind of cuisine for the youth. I think for our target shoppers also. So what happened is that this is an open tender. So in that case, if I think if I'm wrong, it's about 6 bidders into this tender, and basically it is actually if I'm wrong, 60% on price. No, 40% on price, 60% on concept. So in terms of price, we are probably the last or the last second. So in that case, it means that we are not going to pay a lot of high rental to rent the area from the government to sort of build up this area, which I think I remember the first probably is the first in terms of pricing wise, around easily 4 to 5 times above us. So in that case, you can see how conservative we are in terms of approaching to be this area. But I think what we win and convince the government is on our concept. If you look at it from the diagram itself, we are going to actually build up a concert area, which we invite Live Nation. I hope you guys know about Live Nation, because basically they have a lot of international artists under them. They are event organizers, and they are, if I'm not wrong, is they are first or second in the world on organizing events and all things. So in that case, they are quite strong. So we're going to bring them in, build a concert areas for them to actually host the events and all. And then with that, I mean, international artists, performers will come to this place and do the performance. So there's, I mean, it's a very strong collaborations. And then I think that's what I think the government like it. At the same time, we also have another two partners. One is Museum of Food. I think it's a very creative and Instagrammable museum ideas to actually bring people to understand food and all those things at the same time. It's very Instagrammable. The youngster like it. And also, we're going to actually bring some locals, operators to sort of sell some local delight and food to sort of bring back the memories that we have on some of this traditional food that we are talking about in our younger time. But I mean, there's what we want to have that kind of experience on that. So in that case, that become a very different experience, or rather, it's a mix of different experience in a premise itself. You have the food, and you also have a good entertainment. So actually, it gel quite well with the whole precinct developments that the government has, and also more. So to that, I think is a very good kind of involvement that we have, and this will be ready by I think first half of 2022. And it's, of course, I mean, given that we price ourselves relatively low, this will also be a good accretive investment that we have.
What would the whole sort of investment cost into this development?
About 10 million.
10 million. Sing dollars. Okay.
Yeah.
Okay.
So that will be, of course, we will lease the space out. I mean, for example, the Live Nation, we will lease the space, lease out the space to them, and I mean, with the commitment of the leases and all those things. And with that, I think the yield is actually quite attractive to the investors. So I think that's what we actually are trying to make ourselves different. And also, I think given that this is very close to our mall, I think it has a lot of synergies between us and between the mall and this site. And I mean, beside the cost saving that we can probably have in the operations, I think given that we remove this car park, I think the closest car park that people want to park their cars will be in the mall. So in that case, that will also probably improve our mall.
Okay.
At the same time, of course, given that we will probably have some similar kind of synergies and promotions and events between our malls and also this site. So that will also be something that we can sort of like enhance the footfall and the sales. And also the offerings can be also seamlessly extended from our mall to this area. So like, and in that case, we can provide people with different other kind of international offering in sort of F&Bs and sort of other kind of fashions and the kind of things. Given that we are going to bring in international artists to perform, and also I believe people maybe from the Asia Hong Kong, Malaysia will travel here to just come and listen to the concert and also enjoy the concert. That's when I think our offering can be more more open up internationally and all those things. So in that case, that is something that we were targeting and to transform ourselves in a different way.
Yeah, it's quite an interesting and quite strategic, I would say. So no car park, then go park in the mall, which is Somerset 313. Right?
Exactly.
Yeah.
I think with this site that we have, I think we sort of like technically cover, I think, quite a big landscape in Somerset, which I think that's why our collaboration with the government and how to sort of extend and bring out the government intents to this precinct become very obvious. So I think that's why our relationship with the government is also to have to get stronger, so that in the case everything can be bring out accordingly to what they expected in this precinct. Because I mean, this is technically a 10-year less one day kind of site offering list that, I mean, by the government. So in the case, they surely want us to do something that is very interesting to sort of like continue with the plan of the rejuvenation.
Yep.
Yeah.
Okay. So I'm just curious. It's only 10 million Sing dollars, right? I'm just curious. What kind of yields are you guys? When you guys did this, what kind of yields were you projecting?
I cannot share too much on this to you. If not, the government will come after us and ask us why you are not paying so much rental to them.
I suspect it's probably double digit. I suspect because it's for the investment of 10 million. I think it's you're gonna get good yields for this.
It's very good in a way, but I cannot share if not the government will come after us to have.
Okay. All right. I had to ask Kelvin. Sorry.
Yeah, but it certainly is a very good number. But it's just that we we try not to share too much, if not it will create some issues. Yeah.
Okay.
Okay, I think this the next slide is just giving you some flavor of the tenant sales and also visitation. I mean, of course, to us, I mean, we have what we so called the circuit breakers. I don't know, in Malaysia, you all have something that actually something similar that's been is that basically during the circuit breakers or it's a lockdown equivalent that people cannot come out or the place and they can only sort of technically I mean stay at home and also minimal activities going out and all those things. I think likewise is so in the case we experienced that I think somewhere in April and June. So in the case that's why there's a significant drop from our January and March numbers from, for example, the sales from 49 million to around 11.7 million as it actually sort of like dropped because of the circuit breakers period, which is lockdown equivalent. So after that, I think Singapore started to open up in phases. I think we are at the second phase now, which I think the increase there's a rebound, of course, in terms of the tenant sales and visitation correspondingly. So the sales wise, we actually had 3.5 times rebounds on a quarter-to-quarter basis. Likewise, on the visitation wise, we are around 2.8 times higher. I mean, you will be wondering how come the sales actually is not rebounds as the same full in compared to the visitation. I mean, of course, the visitation wise, I mean, there are still some limit in terms of number of people that can be going to the restaurant and maybe sit together in a dining table and all those things. So in the case, there are still some constraint, and also how many shoppers that can be contained in the mall or contained in the shops, or also there's some limitation. And also, I mean, you also need to be your temperature also need to be measured and all those things, and you need to wear a mask and all those things. This caused some somehow that difference between the sales number, how the sales number can jump compared to the visitation. I think the other thing is also because during this period, we actually also collaborate with some of these food deliveries services. I mean, which we try to actually bring our F&B tenants their offerings, their food closer to their tenants by providing some free deliveries and those things. So again, I mean, the shoppers or their customers don't need to come to the mall. I mean, we just deliver to them. Also, that means that the visitation technically are not reflected in the mall numbers. But of course, the sales will be recorded in the sales numbers. So in that case, that's also one of the reasons why it explains the difference in the magnitude of growth.
Okay.
So we move next.
Okay, move next.
These are some of the events that we try to actually sort of get people back to the mall. I mean, during this phase of phase 2, although it's not fully allowed people to sort of like come to the mall, but I mean, it start to open up. I think that's where we try to actually sort of encourage people to come to the mall with some discount. It's like a 55% discount is mainly we try to collaborate with Lazada. So I think around 30 over tenants actually work with us to sort of put some vouchers, promotions in Lazada website, so that in that case, I think also there are some limit, like I mean, number of vouchers available. After you finish, then I think they will stop. So in the case, put the voucher into the Lazada and the people buy it at a 55% discount. So in the case, that also actually bring a lot of the shoppers or a lot of customer back to our mall. And in fact, some of these tenants, they of course fully sold the number of voucher that they intend to actually sell at the platform, and they are being asked to actually to do the next round or the next round several rounds again. So in the case, obviously there are some shops and some shop that is actually good to sort of continue to be able to attract customers and people to spend money. Just that, I mean, you need to be people need to encourage to come during this period of time, because it's probably also quite difficult for them to actually decided to actually come out of home. I mean, after a certain period of stay at home, I mean, people are very comfortable to do online shopping and all those things. So I think that's where we want to change the momentum and change the behavior again, so that to bring them back more. So that's what we do. I think we also do a few things sort of like, I mean, these are the things that we try to do to sort of bring people back.
Yeah.
Yeah.
I guess we all have to kind of figure out and I think wait out this pandemic, right?
yeah, exactly. Yeah, I think it's also a reality check. I would say that, I mean, as everyone, I mean, even before the pandemic, everyone already know the digital, the online is always attract and is the disruptors to the more operators. So actually, how do you want to transform and how do you want to position yourself is very important. I think for us, I mean, we already start thinking of it even before the pandemic. So basically we are focusing on two key strategies. I think one is to focus on tenant with omni-channel strategies. That means this tenant, beside having a physical establishment with us, I mean, physical shop in our mall, they also actually sell online. And basically, we have around 35% of these type of tenants actually in the mall. So when it comes to this pandemic and all those things, they will still be able to survive because they have the online platform to continue to sell, whereas the physical shop is required to close. I mean, to a certain extent because of the lockdown. So in that case, I mean, there's one of the strategy that we have even before the pandemic happened. So this tenant continue to survive, and why this tenant actually choose us also because of our location. So that actually bring out the next strategy you have. We actually attract tenants that actually have this online to offline kind of concept. And I don't know you heard of this Love Bonito in Singapore. I think they started off their operation or started off their sales online. So after that they are successful. So they decided to have their offline shop, and the first shop that they set up in Singapore is 313 at Somerset. And why? I mean, yeah, and I think it's because we are, of course, along the Orchard Belt, very centrally located. I mean, we are not at the east, you're not at the west, town or wherever. We are quite central, and we are on top of the MRT. the Somerset MRT. So in that case, people come to collect the goods, experience the product. They can actually straight away return if they don't like it, or they can buy more of different colors if they want, or maybe some accessory accounting. That's the idea why the offline shop complement with the online kind of shopping experience to extend the shopper's experience. That is the experience that we want to enhance for this type of tenants, which I think for us, because if let's say they are setting a first shop, I think having a centralized location to attract people from the different areas through the MRT or through any kind of transportation, which is actually quite convenient to Orchard Road, I think our mall is actually quite a good place for them to start off with that kind of concept. So in that case, we focus on these two. I mean, even before that. So beside Love Bonito, we have another tenant called Pamelo. Actually, is also an online kind of offering in Thailand, very successful, and they come to us and set up their first flagship in Singapore and in Tree. So in that case, this is what we have been seeing and foreseeing and also anticipating on the disruptors. So I mean, that is why when it comes to this pandemic, all our tenants are forced to close and not to be able to operate physically. I mean, somehow or another still be able to sort of survive through. Of course, we are slowly changing the mix of the tenants. Hopefully, with that, I think that will provide some kind of resilience to the cash flow, and also to complement with the online experience, with the online offering with the offline experience. I think very important is that, I mean, online of course is convenient, but if you also, I mean, to somehow might not fully fulfill the experience of the shoppers. I mean, do you ever happens that you buy a shirt which will come back to you? I mean, the size is different, maybe the shape. I mean, it's not something that you like, and all those things. That's something that I mean, if let's say everyone go onto an online platform to sell, I think how you extend and how you actually enhance the experience of your shoppers or your customers become important. I think the offline shop becomes something that can like sort of enhance this in a way. So I think we believe that it will be able to complement with the online offering. I mean, we don't need to actually look at it as a disruptor. Rather, we actually look at how we can collaborate together to sort of work better for the customers and shoppers. That's the whole thing about it. Yeah. All right, we can move next. Yeah.
Okay. Oh, yeah. Hang on, let me just get it. Yep. Okay.
I don't know whether you have enough time, but you want me to move faster, you can. But
okay. I think we still got another part. We haven't covered Milan yet, right? Yeah. And okay, I got a few questions here. So maybe another 10 more minutes, then at least we can spend a little bit more time on the Q&A, or 5 minutes, to 10 minutes. Yeah.
Yeah. Okay. I mean, as this what I explained to you, the tenant retention is 80%. And this tenant retention is basically our mall, because our Tree and Somerset Mall is nothing to do with Milan, because the Milan is basically anchored by a tenant with also a long WALE. So we can explain that later. So these activities, of course, given the uncertainty of the COVID, it do actually mean some headwinds to us in terms of renewal and also how we're going to lease the space, because no one want to commit until they have some certainty. Oh, maybe a vaccine is ready, maybe certain things are under control. So we can understand the sentiment of the leasing environment. So I think we have different ways to tackle it, but of course, I mean, that is something that we will have some kind of means and way to tackle it in a way. Yeah. So the main tenant is trying to have a wait and see approach, but I mean, they do actually appreciate the location that we have. So in that case, we tend to sort of recalibrate some of their cost structure and kind of thing to sort of make sure that they are able to still operate in a way and also in a fair manner that actually our tenants distribution and cash flow are not disturbed. So that's, I mean, we have some way to manage it, but I mean, that has to be on to another topics, but we just maybe move on to the next then.
Okay, sure.
Okay, these are Milan asset. Basically, this asset is 3 office buildings, freehold buildings, and is actually very accessible to the transportation, which I think is the next slide. I think basically we are 100% occupied. The WALE is about 11.6 years. Asset now appraised value 444.5 million. value cap rate 5.25%, and the size is about 985,000 square feet. Of course, we 100% own it. So I move on to the next.
Okay, yep.
Okay, this basically gives you a good overview of the location itself. Basically, we located at this Milano Central Giulia, which is one of the largest urban redevelopment projects in Europe. I think basically Lendlease is asked to actually redevelop the areas and all those things. And of course, with the collaboration of some of the developers and also some of the owners of the areas and kind of things to sort of transform that area to probably the second satellite city or areas or CBD that around the around the Milan site. So that's what we are doing. And basically, it's a very big transformation. It's about 1.2 billion square meters with idea to transform it to an innovative business district. And also there will be some residential areas. So it's very strategically located and very well connected. It's actually 150 meters. Our building is already 150 meters. I mean, from the subway station and also from a train, and also it's 10 minutes away from this Linate airport, which is actually an airport that you can connect you to all the Europe countries. Yeah, I think that's Milan itself. So you move on. Okay, then we talk about the tenant. Basically, the tenant is Sky Italia, and it's actually 100% owned by Comcast, and Comcast is actually the world's largest broadcasting and cable TVs operators. So in that case, by revenue. So in that case, they are very strong. So Comcast itself is a AAA rated. And if you know, actually, Milan actually is about B plus and kind of thing. So in that case, I would say that our tenant quality is even better than the quality of the country by itself. I'm sorry, no offenses, but it just means that we try to actually make sure that our cash flow and our quality of the quality in the cash flow that we have, and I mean it's true the quality of the tenants that we are talking about. So I think that's what we are trying to position ourselves, and we do have this good quality tenant. I think the other thing is that basically, besides having this tenant, is a long lease that we are talking about, and is actually expiring in 2032, which is again is another 11.6 years to go, as we said. And it actually is a triple. Of course, in between there's a break clause, I think, which they need to serve probably 1 year before that. I think that is somewhere around 2026. That means by 2026, if let's say they want to break the lease, they should inform us a year earlier. But of course, we don't think that they will do so. I think first of all, they are trying to consolidate all the Euro business to this area. And secondly, is that the lease, the rental that we are charging them is relatively low. We are charging them around 175 dollars per annum per square meter. But at this moment, the latest development that is just adjacent to us is charging their tenant around, I think, probably 280 to 300 euro dollar per square meter per annum. So with that, this is another reason why they don't move. And the third thing is that, of course, the labor law in Europe is quite difficult and quite hard to actually move staff from this area to another area without a hefty compensation kind of thing. So in that case, there's another things that we don't think they will move. So in that case, we can disregard that break cost. So in that case, technically, we feel that the lease will be all the way to 2032 based on the lease agreement. And this is a triple net lease arrangement. That means the tenant bear all the costs that they have in terms of the maintenance of the buildings. Their general insurance and all those M&E, all those things. So in that case, what they pay is what we're going to get. And and basically there's no rental waiver and all those things. So in that case, during this crisis, so in that case, during this pandemic issue. So in that case, the tenant continue to pay us the rental faithfully. So in that case, basically, everything is all good. The cash flow continue to be a good buffer for us to sort of sustain the cash flow distribution. So I think that's it. We can move next.
Yeah.
Capital, I think I will not talk too much about this because we sort of cover bits and pieces of that. I think with 35.6% gearing ratio with average 2.8 years, which is actually relatively good, and the running cost about 0.86%, which is also relatively low. I think comparatively, average interest coverage ratio of 9.2 times. We move next.
Yeah.
I think if you look at it, basically based on this chart itself, you can see that there's no refinancing until 2023. Basically, that's been during this pandemic period. I think we are safe and we will not be called back for any loans. I mean, unnecessarily. So and also we have 100% flexibilities in the balance sheet because none of our assets are secured. So none of our property are secured. So in that case, the debt is basically an unsecured debt. So we 100% hedge our interest rate, so that in the case we are not worried about the fluctuations. And also we have natural hedge on euro dollars investment in euro Milan because we want to try to contain that kind of currency movement. So whatever we invest in, we actually hedge with debt itself. That's been 100% debt to fund the euro dollar investment. So I think we have a fully diversified lenders, and then we have around 150 million of undrawn debt in case of emergency. But we don't think we'll utilize it, but we just put it there as a backup for us. Okay, we move next.
Okay, sure. Yeah.
Yeah, I think this is just a brief update of the COVID. I think we will not cover too much on this because we talk about the COVID. I think it's more important to understand the traffic and the sales itself. But this is what we are doing it. But if anything, I think they will come back to you if they have any question on how we manage the COVID situation. Yeah, I think we will not go into on it because it's just some government measures and all those things. Okay, basically, I think this slide will show you what is our plan during this COVID period. I think we continue to actually maintain a very prudent capital management behavior, given that we have a strong balance sheet and with our undrawn loans and also with our balance of around 18 million in our bank account and counting. I think we can sort of sustain the whole period of the pandemic period. And also we continue to be very prudent on our capital expenditure, so that in the case to make sure that we don't over commit to our unnecessarily to any kind of commitment on our investment. So of course we also try to actually manage costs in a way. So we try to see whether we can sort of like get some reduction in costs and also to push out some of these capital expenses as much as possible. So we continue to have leverage on our strategic locations to improve the sales and visitation, and most importantly to sort of like anchor with our new development to sort of have a better offering and transformations in the precinct itself. I think I will not touch too much on this. I think we can move next.
Yeah.
Yep. Yeah. That's it.
Yeah. All right. That's it. Yeah, of course, if you guys have any questions here, you can also download these slides and you can go through them. You can always send an email. Of course, Ling Bilin is actually the IR manager, so if you like to contact them, you can do so directly. Now, what I'm gonna do is kind of quickly, so if you guys have any questions, we are happy to just post them down there. So please post it in the comment below, and then we can start kickstart the Q&A. So this question was actually asked by Stephen way earlier. Stephen, I hope you're still signed on. So he said, other than substantial investments in TRX, would Lendlease have any plans, or Lendlease REIT, I guess specifically, to bid for, I guess, any development in Bandar, Malaysia?
Yeah. Okay. I think that is probably has to be more corporate instead of the Lendlease decision, but I would just like to share with you from the Lendlease REIT perspective is that I think for us, I think there's, or rather for all the REIT operation in Singapore, there's a cap on involvement in the development project. So it's 15% or roughly on your EUM. That's mean your current EUM. So in that case, if you want to bid for a very big project, which involve a lot of development, I think that probably is a no-no for us. So in that case, if we do have any kind of interest to actually bid for a future site, it probably has to be from the sponsor. After that, they fully develop and then they pass it on to us. If let's say it become a income generating asset for us to sort of continue the distribution. I think this is the whole idea about REIT. The REIT is not really, the REIT actually has to focus more on the income generating asset, so that in any case it can produce the kind of distribution to the unit holders and give the kind of stability distribution to the unit holders. That's why development project, it tends to have a period of investment period, which you don't have a return, which we probably don't serve well with to a REIT operation. That's why the government actually put a cap of around 15% of the AUM in the REIT operation, so that in case we cannot invest more than 15% of our AUM in a development project. So to answer your question short, the REIT will need to actually think twice if let's say we actually involved in the development project. If anything that of interest of any of the future Malaysia site will has to be done from our group, or rather the Asia teams, to sort of decide whether to commit to any of these developments.
Yeah, thanks for that. Thanks for that, Kelvin, and also Steven for your question. So one thing I forgot to announce is that look, the link is open now, so you guys, so we're gonna be posting links below where there is a quiz, right? So if you like to partake in this in this quiz that we're gonna do, kind of the first time we're gonna do it, we're doing live here. So you get free $30 touch and go top ups for the first 5 respondents who answer 3 questions correctly, right? All you have to do is click on the link below, answer them, and I'll announce the winners at the end of the show. All right, so stay tuned with us. All right, yeah, that's a quick announcement. Now I've got a question here from Katie here, right? And I think we get this quite often because the story or the flavor of I guess of the current or the now is COVID, right? We know how will malls still be relevant post COVID? Is everyone just going to do shopping online? Maybe some of your thoughts, right? And if that happens, do you actually foresee retail sort of rental rates actually coming down in the next 5 to 10 years if online shopping becomes more prevalent in what we do or in our daily lives?
Yeah, I think it's a good question, and we have to look at it from different angles and aspects of it. But I mean, the core of it is that I think we all are social creatures. I think we like to gather together. We want to meet up with people, socialize, and all those things. That's why sometimes, at the start of this, we call it a lockdown period or circuit breakers. I think everyone is not very comfortable. How do they manage themselves at home and in a confined apartment and all those things. So I think that is always the mentality. So people continue to socialize and all those things, and that's why people anticipate hopefully that it start to have more open up in phases, so that people can actually go out and socialize and mitigate with the people. I think the thing is that how then you actually position yourself and what is the strategy you have in terms of your mall, that's very important. So I think you have to focus on your offerings that actually people that need to actually go down to the mall to sort of experience it. Of course, the easier things that I can think of is of course F&B. People need to go to restaurant in order to enjoy the food, and also maybe some virtual reality kind of gaming, and all people need to go down and have to experience that. So that is one of the things that you might want to achieve. We might want to actually focus on our tenant mix to sort of enhance it, so that in that case we continue to have a very healthy sales and footfall. That's one angle. I think the other angle, of course, as mentioned is that we focus on tenants with the omni-channel strategy. So in that case, to them, I mean, the locations of the mall become very important. As long as the location is something that can actually make people commute and meet together, and probably they can get their shoppings done and at the same time have a meal with the friends, and also further on with a cinema. I mean, there's a cinema complex next to us, and also we have bowling offering in our malls and all those things to let them have the full experience together with their friends. I think that is very important. So in that case, that's something that we need to look at. So those with a omni-channel kind of strategy, it helps us because I mean they can actually get the shoppers to come down by doing a click and collect kind of mode. That's mean they can purchase in online, but then they collect it offline from the shop, and then they do other thing else. So you have to give them a complete offerings in the malls so that make the shopper experience to enhance the shopper experience. Of course, the other things that we talk about is the online to offline kind of tenants. I mean, that is something that we need to focus on, which actually again, I think leveraging on our strategic locations, the development and our identities being how we differentiate are more different from the others more will be a key factors to sort of how we actually manage the going forward trend of the mall and also buying behavior. At the end of the day, I mean, online shopping is not totally it is not going to give you a total full complete shoppers experience. I mean, if given a choice, I think shoppers will also prefer to actually have a feel of the products before they actually buy it. I mean, there will be occasions that you buy something that you don't find that is suitable for you online. I think with that enhanced experience, that also strengthen the brand of some of the online operators, because they notice that I mean shopper experience is something that differentiate themselves on the online platform, and that's why they create an offline kind of more shop to shop, like further enhance the shopper experience. I think that is something that is very forward looking, and these are some of the tenants that we are looking at to sort of like put in the mall. So I believe with all these strategies, if you continue to have a healthy sales and footfall, I think the rental rate will not compromise.
Okay. Thanks. I guess it's also a little bit of a cultural thing, because we see in
Yeah.
the West, or particularly in US, or in when Lendlease is in Australia. I think we in Asia, I guess we don't like to stay home. It's out is better than in, right? And it almost seems quite cultural, whereas I think in the West we're seeing the opposite, where if you don't have to go out, then why don't you just stay home instead, right?
Yeah.
And I guess the question is, well, what happened in the West actually happened in Asia, right? Of course, I think in the last 10 years, if you look at shopping malls, it doesn't seem to be that direction, right? Even with the advent of the internet, So
Yeah.
I sometimes I put it down to culture, but there's no other way of kind of explaining it, right?
But I think you're right. I think culture is one of the many reasons, and also the other thing is that of course you look at compared to US and Europe, right? I mean, the mall is actually not really so close to you. I mean, it's like probably you need to travel, you drive, or you need to actually take maybe somehow a train to actually go to the mall. Of course, I mean, so in that case, to them, I mean, going a mall probably is easier for them to go online to the mall. But for Singapore, it's like probably every few hundred meter you have a mall, or actually every
Yeah.
train station you have a mall. So in that case, it becomes very convenient. So it becomes somehow some place that you just need to, if you need anything, you just go down to the mall and buy. Don't need to go online, because you go online, sometimes you need to wait for a day, two, and sometimes you don't even know when is the good is going to deliver to you. So in
Yeah.
that case, so if you really need that thing, you just go to the mall and get it, and it's still convenient compared to, I mean, the others you see, other countries which they have. Right?
Yeah, agreed. Okay, so I've got one question here from In Kyung from YouTube. So so I'm not sure how you can answer this, but what's a real advantage, you say, going with Lendlease REIT right? Compared to say other REITs, right? Now in terms of dividend yields, maybe I'll answer that question. I think based on yesterday's closing price, today's closing price, your yield is roughly 4.5%. Of course, you have to measure this against Sing dollars, right? Where your interest rate is relatively close to zero, so 4.5%. Don't compare Malaysia, even if you compare Malaysia, it's still higher, right? In terms of higher than your risk-free rate. What's the current? I know your market cap it's about 780 odd million. What's the price to book at this point? Do you know, Kelvin?
If I'm wrong, it's around probably 80% to books or 90%, 80-ish% to books, that kind of things. I think
so it's 20% discount to book basically right now.
Yes,
Okay.
that's right.
Yeah.
So we are actually trading below book, which of course, I mean, it could be due to the sentiment of the retail asset and all those things. But I would say that our quality of the cash flow is one of the things that I think the investor need to sort of look at it, given that we do have this Milan asset that actually are very stable and continue to be very stable for us in terms of the distribution. I think with also the addition of GEM and the GEM itself has this fully listed office, and also with the committed with the rent of IKEA and all those things, it's also considered a very stable kind of cash flow, and you're going to distribute that kind of cash flow to the unit holders. And I mean, to us, 313 is the quickest of the distribution. So in that case, you basically, of course, you will provide that kind of rental cash flow to the unit holder. At the same time, you do have a probability to actually increase in terms of this distribution. Why I say that is because 313 current average rental is about $17. And if you look across Orchard Road, easily it's around 20 over dollars and kind of thing. So in that case, we are sort of like at the lower of the rental cycle. So even if how much we can compromise on rental during this COVID period, and how we can sort of like how the COVID can threaten us in our rental. I think our tendency of going up in the rental cycle will be higher compared to the other malls. There are other peers that actually charging a higher rent compared to us. So in that case, we actually sort of like create this portfolio with a very low rentals for 313 that actually have the uplift eventually. Actually, if let's say that COVID doesn't happen, I think we have a very good chance to actually improve our yield through this uplift. But of course, COVID changed the things a bit. So I would say that we do have a very good quality of cash flow that we can actually sort of anticipate. But given the COVID, it sort of like changed the number. That's the reason why, at the start of the presentation, I already sort of explained to you that we are actually 14.5 times oversubscribed with very strong support of Great Eastern, some of the government links, funds and all those things. They don't support you without reason. They of course see the value of it. Just that unfortunately COVID changed the equation. That's why things change. But we continue to believe that we can still have some good strategy in 313. I think also with the development of the Grange Road car park, I think that will create also some values to it to enhance the cash flow distribution. And also, I think 313 is given additional plot ratios from the government, so that in any case we can actually sort of increase our lettable areas, which means that you will increase the distribution to the unit holder as long as we activate these additional plot ratios to sort of expand the area that we can lease out to the tenants or potential tenants. So in that case, that is all things that is going to be a good. There will be, a lot of good cash flow that coming in the future. That's why I think of it.
I also can give you one reason. You don't see many REIT CEOs coming and engaging investors at this point in time. So kudos to you, Kelvin, for coming online and engaging investors. Obviously we are in difficult times, right? Not many mall or REIT type CEOs are out there sort of engaging investors in good and bad. And I think it's good that you guys are doing that, proactively.
Yeah, I think I would have to thanks to Bilin that always make me very busy to engage with the investors. She always fill my timetables with a lot of engagements. But it's okay. It's interesting. I think given that we are new in the market, I think it's good for us to sort of share more with the investors so they know us, they know our thinking process, they know that how strategic we are to sort of like plan out our our move next what our next future move. And also some might not even know that this will be the one and only REIT that Lendlease has. I mean, which I think without sharing with you guys, I mean, no one's I mean through this sort of platform, no one knows. And then they don't know the sponsor will be probably create another one that actually sort of like compromise our development and growth. So I mean that is something that I mean through this platform we can sort of share. I think it's very good.
Yeah. Well, we hope to welcome you back another time, hopefully for an update.
Yeah, certainly. Worried.
I've got one last question sort of before we end, and then I'll announce the 5 winners. So from what I hear from my colleagues, I'm seeing on my left screen, a lot of you guys started very quickly answering those questions. So I've got maybe one question here from Jason here. With the pandemic of us changing consumer behavior, is there going to be a going digital? Is there a trend, of doing the new retail, where in China, they all get to try stuff out and then they buy it online, right? Is that something that you guys are working with your existing tenants to kind of, also evolve with potential changing consumer behaviors?
Yeah, I think it's a good question, and perhaps I never elaborate much on that. I think it's good to point out also. Yeah, we do actually, even before the COVID start, I think we do have a lot of social platform and kind of things to connect our investors. Of course, those social platforms is rather passive, it's more of sharing with them on that kind of wherever there's offer in the mall and all those things. But we do actually are the starters of this, or rather we do have a very good populations in this platform. And also we do have this loyalty program actually is through apps that people can actually sort of and they spend and they can claim royalty points through the apps. At the same time, this apps itself is differentiate itself because it has a tenant platform. The tenant can also post their wherever they want to offer to our member directly, because this platform is linked to our members. So in that case, that is also one of the things that we do. And yes, I think we do collaborate, for example, with Lazada to sort of like put our tenants to this platform to sort of continue to actually do the sales for those that don't have this omni-channel strategy. So we sort of connect them, and we also probably want to provide them with this platform in the near future to sort of help them to sort of like have a common platform for them to actually sell and actually promote the services and offering. So at the same time, yeah, we are looking on this live online kind of bidding and kind of thing to see whether it's interesting or not. So these are all the things that we are going to look into it. We want to take one at a time, because not all strategies are fruitful. You can invest a lot, but end up your return might not be actually sensible. So in that case, we are very careful with spending unit holders' money, and also spending make sure that the returns is actually sensible. But yeah, we are looking in all this. None of it actually, some of it we already started, some of it actually is because of the COVID, and we think of it could be one of the things that we leverage. But we don't want to be reacting because we are panic. We want to make sure that it's a strategies that we actually go into it with a longer way to idea of how we actually want to manage it. For example, the data management, we can manage the data to understand the behavior of the spending and all those things. So these are something that we look at the holistic instead of just nervously going to something to sort of like get sales in, but it's a wrong strategy in long term.
Yeah, thanks for that question. No, actually, I was gonna end it, but I got a few interesting questions here. If you indulge me. Yeah. So I've got a question here from CH on working from home, right? How does this affect your grade A office in Milan? We understand it's a broadcasting. Is there a broadcasting studio?
Yes. Yeah, it's a broadcasting studio. So in that case, technically, they do have live show. Before the pandemic, before it happens and all those things. So when they do the production on site. But I think with the with the pandemic, everything was sort of stopped. So in that case, they also control the number of staff going back to the office, but they continue to have programs and all those things to sort of broadcast and also to sort of continue to produce some kind of film and all those things to sort of like show it to the audience. So in that case, it will not be working from home will not technically affect the operation, even that they do actually continue with the operation in a normal manner. Of course, doing in a offline, doing from home instead of online kind of thing. But I mean, we will have to just adapt and change it. But it didn't actually affect the operations so far as we know from our tenants.
Yeah, I guess it's quite an interesting question. Why? Because I think most of us are quite used to working from home. But I think if you're in broadcast and you have all the equipment and studio all set up, I think that's probably something you cannot work from home, right?
Yeah, they do have some staff that actually need to go back, but they try to control the number of people. We last heard is around 10 to 20% of the staff need to go back to the office or need to go back to the studio to actually do some of these things. But they manage it in a way that it's not like all people going back. Unless it's necessary. If not, you are not required to go back. Then you don't go back. Kind of things.
All right. Okay. So now I'm gonna thanks for that, Kelvin. So I'm gonna quickly make an announcement. So I just want to clarify a couple of things. Lendlease is actually listed on the ASX. Okay, so that's a group structure. Lendlease REIT is part of the Lendlease group, but Lendlease REIT is listed on the SGX. Okay, so don't go and buy the wrong stock. Okay, tomorrow. All right. Just want to clarify. Okay, so there is also a So let me just kind of very quickly announce this. I'm just trying to. Okay, so we have 5 winners here. Okay, so if I'm reading your name out, just check your email, right? Shortly. So we have Chia Cheng Yi. Okay, congratulations. Darren Ng Kok Cheng. Okay, congratulations. Joey Chin. Lai Sun Wai and Ang Shai Ping. Okay, congratulations. Check out your emails. We will send you the details in your emails. Now, before we end, I just have a very quick announcement. Let me kind of just get that out. Just give me a moment. Yeah. Okay. So very, very quickly, we have our next live sessions coming to you this week. So this Friday, 8 p.m., don't forget, we have a club meeting, newly IPO'd company, Maiden. They are in the solar business. So we have the CEO who will be coming to present, lady CEO. Okay, so 8 o'clock, don't forget, for Genius subscribers. Don't forget, on Friday as well at 6 p.m. We actually have a quarterly briefing from Perak Transit. So please make sure you register yourself before the event. This will also be live streamed and you can talk directly to the management as well. Next Wednesday, we have Notion VTech who will be talking about their 4th quarterly results. That's at 6 p.m. again on Wednesday as well. All right, so those are 3 announcements. Now, let's if everyone can just give a comment and say thank you very much to Kelvin and of course Lendlease REIT CEO, of course Bilin. I hope you're hearing this. Thank you for organizing this as well. We've been running this for an hour and a half now, so I think we're going to take a break now. But thank you again, Kelvin. We hope to have you again on the show. Thank you for that 1.5 hours of your precious time to share about Lendlease REIT.
No, thanks for the time and have a good evening. Thank you so much.
All right, thank you. Thank you, everyone, and bye-bye.
Bye-bye.